Welcome back to New Day Cleveland. Since the beginning of the pandemic, low interest rates have become the norm. But this can make it hard for investors to get returns. And here to talk about strategies we can use is certified financial planner Jim Lineweaver. And Jim, this is one of those things where everyone's sort of happy if you're buying a home or fixing a home, you have the low interest rates. But then we'll get inflation here. So this is going to make it a little hard on investors, isn't it?
It is. I mean, if you look at savings rates, CDs, even fixed income, it's extremely low right now. And the Fed's not expected to raise rates till the end of 2022 or possibly even into 23.
So how do you deal with this? How do you contend with inflation? You know, it's like the bottom's falling out of it in a way.
It's not easy because if you look at the last 3 months, inflation has averaged over 5%. Yet, if you go back to 1926, it's only averaging about 2.9%. So to put that in perspective, let's say you had $100,000 in a savings account. Even if you could have a high-yield savings account, or let's say over a 10-year period of time, you know, at the end of that 10 years, you'd have a little over 100,000 in there. But in purchasing power, you'd have less than 80,000. So it's kind of a hidden little, you know, kind of thing that robs from your returns, and that's what you have to be so careful about.
So I guess it's all about strategies, and you sort of have to have a plan, and you can't overreact also.
No, you can't, because matter of fact, we're seeing the biggest disparity between interest rates and actually inflation since 1980. So when you look at some of these strategies, you know, even on the fixed income side, you don't want to just get rid of bonds, but you have to do it in a very professional manner and really have somebody that can help you, because if you're going to use ETFs or mutual funds, you want to stay in the shorter term duration. But what's preferred is actually individual bonds, and maybe what you could do is ladder them out over the next 3, 4, or 5 years, so that as one matures, you just roll it to the end of that curve. And if interest rates go up, you'll be rewarded, not penalized, if interest rates go up in the future.
You know, a lot of these things you say too. I mean, it happens to me. I'm sure it happens to a lot of people that watch and listen. You know, you talk about some of these strategies, things you can do, and your eyes start to glaze over because you don't understand it totally, and it tells you really why you do need a financial quarterback, because you know that's your specialty.
Exactly.
So we talk about one strategy there. Are there other strategies?
Yeah, there's quite a bit more. So you can look at TIPS, which are Treasury inflation protected securities to stay ahead of inflation. You can even look at some preferred stocks, which is a hybrid between a stock and a bond, but they are interest rate sensitive, so be careful. But one of the best ways to combat inflation is actually dividend producing stocks. So a lot of people don't realize about 40% of the returns of the S&P 500 comes from dividends. So even if you just look at some of the good bellwethers out there, like whether it be Procter & Gamble or Pepsi or Walmart or even Johnson & Johnson, for example. So if you take Johnson & Johnson and you look back over the last 50 years, on average, the return of the stock has been up a little over 9%, but the dividends have actually increased over 13% a year. So we're not saying run out and buy because there's risk with individual stocks and stuff, but if you can see a good quality professional and look at some dividends, it can really help people out, especially in retirement.
Okay, so you've got a bunch of people out there that you take care of their money. You're their man, their financial advisor, and they hear about the market crashing a little bit yesterday, and then we're talking today about inflation and this big gap here. So do your clients, do they feel like they have to call you, or they don't have to call you, or why don't they have to call you, and how do you take care of them so that they don't have to worry about all this stuff?
Well, a lot of people ask me about this because we're very proactive with our clients. So by the end of the business today, we sent out a, you know, kind of an email that summarized what happened in the market, because actually the market went down over 900 points yesterday, but only closed down over 600. Still a lot, but in perspective, what happens is being more proactive with clients, you don't have to be as reactive. And when we talk about things like dividends, no matter what's going on in the market out there, they're still getting paid. So a lot of education, but being proactive with our clients as opposed to reactive, which I know a lot of other advisors are.
And I hear a lot of people talk about, you know, don't overreact to this kind of stuff, because you know, a lot of people, if you're handling your own money out there, you can make a lot of mistakes. I mean, you could go like, oh, sell, sell, sell right now before it gets lower, and you might miss the next upside because you jumped out too soon.
Well, also people get their emotions involved in investing, and that's the last thing you should do. And that's why you do need to see a good professional that can kind of put those at ease and stick to your plan that you come up with to make sure you can maximize things like retirement and things.
What's the number at Lineweaver so they can get a hold of you?
216-520-1711.
Okay, don't forget that, folks, because that is very important. There's the information for you right in front of you. He is the financial quarterback, and of course you catch him on Sunday mornings on Fox. Some great information each and every week. Thanks a lot.
Thank you. Appreciate it.
Okay, folks, coming up, how one local van is preserving the history of Thomas Edison.